Commercial real estate financing. Today, we're going to decode this. We're going to talk about what it is, how it works, the kind of terms you can get, where to get approved, the kind of different financing it's available. By the end of this training, you're going to know everything you need to know to be able to get financing for a commercial building, whether it be a building that you're keeping your primary business in, using it for investment property, or if you're buying or refinancing, we're going to decode it all. So our phone number will be on the bottom of these slides and in the beginning and end. If we can help you along the way with getting any kind of financing for your business, please let us know. So let's first talk about what is commercial real estate financing, or CRE. Well, ultimately, this is typically used for income producing properties. So a lot of people use commercial real estate financing to be able to go out and buy properties that they can then lease or rent to others and earn a rate of return. Okay, so examples are retail malls, professional offices, dentist office buildings, and where I am right now, we have a hospital right down the road. So a lot of our office space are medical offices. They're used for all kinds of doctors' offices and everything that's similar that's related to the medical field. So with real estate financing, you can use this for acquisition, you can get it for development, you can even construct and use this for the construction of new commercial vehicles or new commercial buildings as well. So a lot of things you can do with it, and there are mortgages secured by liens on that commercial property. So ultimately, I talk about a lot of different kind of financing based on your cash flow, financing based on your credit. This is financing based on your collateral, and the collateral here is commercial real estate. Now, what's interesting about this is a lot of the commercial real estate financing we're doing right now, we're finding people that are able to get in with little to no money down, own the building they're currently leasing or renting, and have payments lower than what they're paying right now. So a lot of benefits with commercial real estate financing, including the fact that you could even buy the building you want to occupy or buy the building you currently already do occupy, and then possibly have no money or little money down and be able to get payments cheaper and more affordable than what you're actually paying in lease payments or rent payments right now. Now, these loans are often actually issued to entities, developers, corporations, limited partnerships, funds, and trust. And these entities are often formed for the specific purpose of owning commercial real estate. It's very different. In this case, yeah, they will do commercial real estate loans for individuals, but typically some of them are guaranteed by individuals. Some of them are not guaranteed by individuals, and we'll talk about that too. But again, a lot of these are actually issued to business entities that are developing commercial real estate, that are actually constructing it, or even entities that are just owning it, that they just own multiple properties that they then lease out or rent out. Chili, cheers to you from Facebook. Humane says, this is the best. You're the great. I appreciate it. And Daryl coming in from LinkedIn. Impossible is nothing LLC checking in, waiting on Zorro to start reporting now, Ty. That will make 7 trade experiences. Great job. Daryl is crushing it on building his business credit. And Quentin says hello. Daryl says hello. And Daryl again says, glad you're teaching this. Next venture is a real estate LLC. I am here to serve, Daryl. So thanks for tuning in from LinkedIn, which we just started going live this week. So again, when you look at that, in order for the business or for the loan to actually be issued to the business name, the business has to have some kind of financial track history, specifically a credit rating established. That's why I talk a lot about business credit and why Daryl is talking about building his business credit. So he's well on his way to being able to do this. Meaning that if you want to get credit and you want them to be able to finance primarily in a business name, that business needs to establish a corporate credit profile. We talk about this all the time. If you've not done that, well, then you're probably going to have to guarantee the loan. But if you have done that, then there's also cases where you're able to get financing again for the entity instead of the individual. And then that way you can actually get it without a personal guarantee in some cases. And we'll talk about that here in a minute. So if the guarantee is not required and the property is the only means of recovering the debt if the loan defaults, then that's called a non-recourse loan. Okay, it means that the lender has no recourse against anyone or anything other than the property. So remember, when we talk about liability, primarily we're talking about something very basic. If you default on the debt, the loan, the credit card, whatever it may be, who can they pursue? Can they come after your personal assets, or they come after the business's assets? So the goal here is to get as much credit and financing we can without a personal guarantee, because then that means if you ever default, they can come after the business, but they can't come after you individually. This is where SCORE and Inc. and SBA, Entrepreneur, all the major companies out there, or the people that teach entrepreneurs, publications, etc., they all preach the importance of separating consumer and commercial credit for this reason. But a lot of loans or credit lines really are not available unless you build without a guarantee, unless you build substantial amounts of corporate credit first. This is a type of financing you can get that's not extremely difficult to get without a personal guarantee. You can get non-recourse loans. They're very popular in the commercial real estate world. But again, in order to get non-recourse loans, you really have to have some very well-established corporate credit. So unlike residential loans, terms of these, commercial loans go for as little as 5 years, 30 years. Actually, a lot of residential real estate goes as much as 30 years as well. But the amortization period is often longer than the term of the loan. Amortization is an accounting technique. It's used to basically periodically lower the book value of a loan or an intangible asset over a set period of time. So a lender, for example, might make a commercial real estate loan for 8 years with an amortization over 30 years. So what it means amortize is it means basically how long you have to amortize all those payments over, which lowers your overall payments. So in this example, here the investors would make payments for 8 years of an amount based on the loan being paid off in 30 years. That would be followed by one final balloon payment of the entire remaining balance of the loan. So what can happen in these situations is that they give you amortization over 30 years, meaning your payments are basically divided over 30 years, but they're only giving you an 8-year loan term. At the end of 8 years, you owe all of its remains. That's a balloon payment, which in that case gives you 8 years, for example, to get a better loan if you want to. So this is really good because you're able to, for example, get into hard money loans, soft money loans, which we'll talk about both in a few minutes. It's easier to get in that kind of financing. You can get an 8-year term, 30-year amortization, keep your payments low, and that gives you 8 years to be able to fix whatever the issue is, then to get out of the hard money or soft money loan and get into an SBA 504 or any kind of conventional loan on that as well. So this gives you the ability, even if you have challenge credit, even if the property's not generating a lot in revenue or rent, to fix those issues. Even if you have personal credit issues, your business credit's not established, you have time to fix the issues that are causing problems where you can't get the exact financing you want, 30-year term, low payment, and then you still get low payments because it's amortized over 30 years, and it gives you time to be able to fix the underlying issue. So you're then able to refinance out of it to a better kind of loan. So we'll talk about that a little bit more. Glenda says, hey, and Ladybug, hello from Austin, Texas. Thanks for tuning in. Nicholas, Ralph, thanks for tuning in. And Isaiah, thanks for tuning in. Always a pleasure to have you as well. So I appreciate that. One of our users says, I have business credit established, but I guess it's not enough because they always deny me without my personal. Well, again, it depends on what you're applying for. There's a myth, and I actually heard a video on this earlier today where a lady was talking about business credit. She was a little off in the content because what she said is business credit's not used when you qualify for loans, and you can't even get a loan from a conventional bank without having established business credit. SBA says that all over their website. But ultimately what happens is you can't get a lot of high limit loans and credit lines just based on business credit quality. When you start to get into high limit loans and credit lines, they want to look at other things, including business credit. So it ultimately comes down to how many you're actually applying for, or probably, what you are actually applying for. Credit cards, very easy to get by business credit quality. Commercial real estate loans, more obtainable based on business credit quality. High limit credit lines and loans, much more difficult to do unless you have ridiculously established business credit. But establishing business credit makes it easier to obtain that kind of financing. So the length of the loan term and the amortization period affect the interest rate as well. Depending on the investor's credit strength, these terms may be negotiable, but in general, the longer the loan payment term, the higher the interest rate. So when you're coming into hard money, soft money, this is kind of the way that it is that if you want a longer term, you can pay for it. You pay for it by paying a higher interest rate. I like to say that people get too caught up in interest rates because it's tax deductible. You get all that money back, you pay an interest by the end of the year anyways. What you need to do is work to have cheap payments. Lower payments are what's important because if you have lower payments, the interest that you pay is typically based on risk, as you see here, loan term, credit strength, the property, the value of the property, what type of property is, all those kind of factors tie into that. And again, the lower risk means you get better terms, longer interest or longer loan terms and lower interest rates. So another thing you're going to need to know with commercial real estate is called LTV, or even in residential real estate, this is popular. It's called loan to value. And it's basically the value of a loan against the value of the property. So a lender calculates LTV by simply dividing the amount of the loan by the lesser of the property's appraised value. So here's a simple example, a really simple example, right? $100,000 property, it's worth $100,000, and a loan for $80,000 is an 80% loan to value. $80,000 loan is 80% of the $100,000 value. So that's an 80% loan to value. So whether you're buying any kind of real estate, loan to value becomes very important. And what you're looking for is to get the highest loan to value that you can get. And the whole mortgage crisis, what happened in 2006, 7, 8, is that lenders were lending 80% loan to value and second mortgage lenders were lending the other 20%. So people were basically able to get 100% loan to values even with challenge credit. And obviously that didn't work out too well, but that is how loan to values work. Now, borrowers with lower loan to values will qualify for more favorable financing terms. That is the way that it is because the risk to the lender is less. If you get a 90% loan to value versus a 40% loan to value, and if you ever default on that loan and don't pay, well, it's way easier for the bank to take back the property and sell it and get their money back if you only owe 40% of the property's value versus if you owe 90% of the property's value. So when we look at interest rates on real estate, credit, whether it be commercial or consumer credit, with commercial real estate, commercial credit's really important. So credit and loan to value are two of the biggest factors that will affect the interest rate that you pay. So if you don't like the interest rate, well, then work on building better corporate credit or work on putting more money down to have a lower loan to value. Okay. And because that's ultimately what's going to lower their risk, and the lower the risk to the lender, the better payment that you're going to have. Now, Lil says, you mentioned trade line account reporting and trade payment experiences. Which one do you track to move on? I have 4 trade lines, but payment experiences, 7 payment experiences. What matters more? I don't think it's a matter of what matters more or less. Great question. And what Lil is basically saying is that a trade line is the reporting of an account in your credit reports. A payment experience is the reporting of an account to a business credit reporting agency. So I have one account that reports to Dun & Bradstreet, Equifax, and Experian. That's 3 payment experiences. So when it comes to corporate credit building or building business credit, Lil, we really go off payment experiences. We guide our clients through how many payment experiences they have, which means you could build business credit faster if you get accounts that report to multiple reporting agencies, not just one. So hopefully that answers your question. So commercial loans tend to fall between 65, 80% loan to value. Some may be higher, some are less, kind of depending on the risk. But again, that gives you a pretty good idea of what the actual, of what's possible. 65, 80% of what you're of what the actual value of the property is, or what you're buying it for even. So if you could buy a property right and you're buying it for 100 grand and it's actually worth 200 grand, well, then that could really even help you get into a scenario where you're putting less money down. But again, 65 to 80%, basically when we're talking about especially how much of a loan you're getting in relation to the actual what you're buying the property for. If you can buy the property right and get a considerably higher value for that property, it means you can get even less money down. So something to consider. So debt service ratio or debt service coverage ratio or DSCR, very important when it comes to commercial real estate. And this basically compares a property's annual net operating income or NOI to its annual mortgage debt service. So this includes principal and interest, and it measures the property's ability to service its debt. That sentence is very important because when it comes to commercial real estate, what they care about more than almost anything else is the property's ability to pay that debt. That's what they want to have happen. They want you to buy a building that, for example, has 5 offices in it. You're going to occupy 1. The other 4 you're going to rent. The other 4 already have a history of lease payments being made, and those lease or rent payments being made are considerably higher than what your mortgage payment would be. That's what we look at when we look at a DSCR, a debt service coverage ratio, or again, a DSCR. What it really comes down to is how much money does the property generate in income compared to the mortgage payment itself. And obviously, the more income above and beyond the mortgage payment the property generates, well, the more peace of mind the lender has, right? Because if you owe $500 a month on the property and you're getting $2,000 a month on rents, well, that makes a lender feel really good, because even if one person doesn't pay on time or 2 people don't pay on time, the property is still generating more than enough income to actually pay the debt payment, the mortgage payment itself. So this is very important. I take a screenshot of this if you're interested in commercial real estate, because debt service coverage ratio, or DSCR, is one of the most important factors when it comes to actually coming in and buying a commercial property. Facebook user, yes, I want to use credit cards I can use for my business purchasing real estate. Keep building business credit. What kind of credit you can get Depends on how many accounts you have reporting on your business credit reports to follow up on that. Isaiah says, hopefully this is not off topic. I have a 74 Paydex score, 64 Experian, 360 Equifax score. I have about 5 active trade lines reporting to DB, but I'm stuck at what I should do next to get gas cards. With gas cards, you need to have about 8 payment experiences across the reporting agencies, and that's it. All you have to do is just build at least 8. Then you can start going to Sunoco, Conoco, Exxon, and start getting approved for those. If you don't have enough, you're going to know because they're going to give you net terms versus revolving terms, or they're going to ask for a deposit or personal guarantee. If you're not asked for a deposit or a personal guarantee, you know you have enough trades. If you are, you don't have enough accounts reporting to get that. Ladybug from LinkedIn says, I own a commercial building, received SBA loan, and am renovating the building to lease out. Congratulations. Any recommendations? We'll talk about that. No mortgage payments. Keep doing what you're doing. If you already have the commercial building and you already have an SBA loan, you're in great shape. Finish the renovations and then lease it out. If you need money for renovations, I'd look into business credit. We've got a great credit line hybrid program. There's a lot of other funding you can get to get the money you need to do those renovations. By the way, you could have got a loan that gave you the money to do the renovations initially when you bought the commercial real estate, but it's too late to have that discussion now. You already have an SBA loan, fantastic loan. If you need money for the actual build out, then let us know. We can help you with that as well. And it's calculated by dividing the NOI, which remember is net operating income, by the annual debt service. We're going to take a look at an example here, seeing what that means. So for example, a property with $150,000 in net operating income, that's the net income it's generating from its rentals. Okay, and $100,000 in annual mortgage debt service, that's your mortgage payment. So in this case, you pay $100,000 for mortgage payments, you get $150,000 in rents on the property. Well, that would give you a DSCR of 1.5. Okay, 1.5. Typically, lenders want to see 1.25%. So in this same example, what they want to see is that you have a $100,000 annual mortgage payment and that you have $125,000 coming in rents. That's 125 or 1.25 DSCR. That's what they really want to see, is 1.25 or higher. So this ratio helps lenders determine maximum loan size, and it's based on cash flow generated by the property. Now, what do we do here? And Ladybug actually brought up a good point. Well, she bought the property for herself. Maybe she's going to lease it out. Maybe she doesn't. But what if she bought that property for herself? Well, you could still qualify for commercial real estate financing, but then your business needs to show that it's generating enough net profit to cover the actual mortgage payment. So that's possible as well, but DSCR is the primary way they want to see it. They want to see that your rents are covering enough, more than enough to pay that mortgage payment. So a DSCR of less than 1 means a negative cash flow. So for example, a DSCR of 0.93 means that there's only enough to money coming in from your rentals to cover 93% of the debt service, which means 93% of what you have to pay up for mortgage payments, et cetera. So in general, commercial lenders look for DSCR of at least 125% or 1.25, and this is to ensure adequate cash flow. Bottom line is, they want to see that your property is generating rents 25% more than you're expected to pay for the actual mortgage payments and expenses. That's basically what it comes down to. That's what they're looking at. So a lower DSCR may be okay for loans with shorter amortization or properties with stable cash flows, but higher ratios may be required for properties with volatile cash flows. These include, for example, hotels, because hotels do not have long-term rentals in there, right? Which with other types of commercial real estate have. This is just an example here, okay? Some types of property, if you have a lower DSCR, it's still okay. Other kinds of property, they're going to want you to have a higher DSCR. And for this is a perfect example. When you look at, for example, hotels that have high turnover, well, then that's where they're really concerned about how much money is coming in, and that money that's coming in is considerably higher than what you're actually paying for that mortgage payment. So it just depends. If you've got tenants that are signing 3- and 5-year leases, that goes a long way to help you get better terms. Like if you're buying a building and there's 5 tenants and every one of those tenants is locked into a 5-year lease, lenders love that because that gives them a lot of stability, especially if that DSCR is 1.25 or higher, which we just talked about what that means. So what sorts of interest rates and fees apply here? Well, interest rates on commercial loans tend to be higher than residential loans, kind of the same way with almost any kind of financing. Commercial financing is a little bit more expensive than consumer because businesses can afford to pay it. Commercial real estate loans also involve fees that add to the overall cost of the loan: appraisal, legal fee, loan application, loan origination, and or survey fees. Some things to think about that you're going to have to take into account, whether you roll them into the loan, which you can do, or not. Some things you're going to want to know. Some costs must be paid up front before loan approval or rejection. Others apply annually. A commercial real estate loan may have restrictions on prepayment as well. So again, you want to take a look and see, is there any kind of prepayment penalty? If you want to pay it off early, you need to know if you're going to be penalized to pay it off early. I'm not saying it makes sense or doesn't make sense. It depends on whether you're a Dave Ramsey fan or, other fan where they think debt is okay because you're using other people's money to get ahead. But again, you want to know if there's a prepayment penalty because it will affect the kind of loan you get. You're going to want to get a loan with or without a prepayment penalty, depending on what your goal is with the property. And Kyle says, what type of score? We'll talk about this. It's very possible to get this with 500 scores. And we'll talk about that here in the next slide or two. And when Lil says, when filling out an application, if a PG is wanted, should I fill out the PG section and leave off my social, or should I skip the PG section entirely? You want to leave the PG section blank and your social blank. And but they may, depending on the source, if you're applying with a major bank, they may actually have you provide your social security number for verification purposes only. In 2018, June, the United States government required banks to verify your identity before they open a new account, which means if they open up a credit card for your business, they have to verify you as the owner actually exist. And it's created to prevent money laundering. So you can leave your social off the application and leave the PG section blank. And then you still might have to provide the social to them, but you need to clarify that you're only providing it for verification purposes and not for personal guarantee or credit check purposes. So you can invest in real estate with a 7A loan, or an SBA 504 loan. Let's talk about the difference here. Almost all commercial real estate is going to be financed through an SBA 504 loan. It's the best loan you're going to get. Ladybug was just talking about hers, and this is the best loan because it's the longest term, lowest rate. Okay, now there's two types of SBA loans. 7A, not usually used for commercial real estate. 7A is what's called working capital, which just means you can use it for any reason. So anytime you see financing, it talks about working capital, it just means like you can use it for general purposes. An SBA 504 loan only has one purpose, and it is to collateralize commercial real estate. So SBA has one specific loan program for the financing or refinancing of commercial real estate, and it's called a 504 loan. Those are usually available from conventional banks, Bank of America, Wells Fargo. I've got a great SBA guy. We've got multiple SBA people. So if you're looking for loans from SBA brokers, we can get you connected. My guy got our PPP loan done in 72 hours when everybody couldn't get anything done. I mean, our guy's phenomenal. So that's the guy that does my personal loans for SBA or our business loans, but we've got a lot of sources we connect with. There's also hard money loans, and these are just from private investors. Hard money lenders are from private investors. So since they're not from lending institutions, they're not guaranteed by SBA. They can be more flexible on the terms, higher loan to values, worst credit, all those people can qualify. Somebody just asked here, Kyle said, what credit score is needed? You can get into commercial real estate financing with 550, 580 credit scores. So even mid 500 credit scores, but you can't go through a conventional bank like SBA. You'd have to use like a hard or soft money lender. So joint venture loans allow parties to share the risk and returns from commercial property without having to formally enter into real estate. But again, hard money loans with private investors are a great way to go. Freddie Mac, Fannie Mae, credit unions, even life insurance companies offer commercial real estate financing. HUD is another option as well. And there's a lot of online marketplaces too that you can get soft money loans. And these are kind of through fintech lenders. And we use fintech as an overall term. It just basically says online lenders. A lot of fintech lenders now are basically online lenders. And there's a lot of them out there. So a lot of different options here. The harder to qualify loans are Fannie Mae, Freddie Mac, and SBA 504. Those are the harder ones. Those are the ones where your credit needs to be good personally. You're probably going to have established business credit to get them as well. Your loan terms are long. Your interest rates are small. Exactly what you want. If you're higher risk, the property is kind of shaky, doesn't have a good DSCR, your credit's got issues, those kind of things. That might be where you go to a hard money or soft money type lender where you have a little bit more flexibility. But typically, they're going to lend on a lower loan to value. So typically, you're going to have more money down or buy the property really right to get into soft money and hard money kind of financing. And the E-Fund says, is there cash? Is there a cash card and all you can get with a no PG? There are some, and they rotate in and out. So, for example, BJ's has a great one that comes and goes, not just an account where you can actually come in and actually get a BJ's credit card to spend at BJ's wholesaler or wholesale warehouse. You can actually use it anywhere. So that's a perfect example. But those come and go. But you can't even talk about cash credit until you get to about 14 accounts, just so you know. And Sharita, thanks for coming in on YouTube. So what do most lenders look for when checking the quality of the commercial real estate financing? Well, it depends on the lender and the type of financing. Okay, they're going to want to look at the available collateral. They're really going to look at the commercial property. They want to see the survey. They want to see the rent schedule on that property. They actually want to see the appraisal of the property, the condition of the property. All those kind of things will factor in. They're going to look at borrower creditworthiness. Remember, if you are the borrower, they're really going to care about your credit. If the business is the borrower, they're really going to care about the commercial credit of the business. Certain financial ratios, we talked about that as well. The DSCR, they're going to look to see how much money you're bringing in on rent exchange to over and above the mortgage payment. They're going to look at loan to value as well. And borrowers may have to provide several years of financial statements, tax returns, etc. The financial statements are scrutinized more if the property doesn't earn enough income to cover the debt servicing, right? That's how it works. So again, if we come back to Ladybug, she's buying a property for herself. So because she's buying a property for her own business, well, not for herself, but she didn't buy a property, it sounds like, that already had renters in it. So as a result of that, well, they're going to really scrutinize her financials. They're going to look at her tax returns. They're going to make sure her business is generating enough income to pay the payments on that commercial real estate. Now, if somebody comes in and buys a property where, again, they're bringing in $2,000 in rent and $500 in a mortgage payment, well, then the financial statements might be requested, might not, but they're not scrutinized as much because the property can support the debt. I can't say this enough. I'll say this almost every time I talk about business funding. What the lender always cares about most is your ability to repay the debt. That's what they care about. All this stuff they ask you for, all this crap they ask you for, the verification, it's all used for one main purpose. Do you make enough to pay the actual payment that you're getting from the loan? And commercial real estate financing, surprisingly, is way easier to qualify for than a lot of other financing because, again, they can simply verify that the rent you bring in alone is enough to cover the debt payment without even looking at your business revenue. That's one of the reasons this is one of the easier kind of financing because the property typically can generate enough income. And when you buy it, typically is generating enough income to actually pay the mortgage payment, or they might not even consider doing the loan. So there's a lot of type of financing we offer that are through 1,000+ different type of funding sources, $100,000 to $20 million type loans you're able to get. You're able to buy or refinance a property. Even if you're doing a cash out refinance or taking cash out, you can even do 70% cash out, taking cash out of a property. Now, remember, as I mentioned, a lot of people right now are coming in right now and buying properties that they're already in and getting cheaper payments than they get leasing the property. Okay. And they actually can come in with little to no money down. How's that possible? Because a lot of people right now are able to buy property very cheap in relation to its value because landlords are freaking out about what's to come. I mean, look, I just on my podcast yesterday had a guy that what he does is he buys bad mortgage debt. And I can tell you that what we're going to see in the months to come with foreclosures, from what I hear with experts in the space, could dwarf whatever we saw in 2008. If that's the case, we see real estate prices decline. I'm not speculating here. I don't know, right? I'm just telling you what I hear from the experts in that space. And if residential real estate value declines, then commercial real estate typically is about a year behind it. It follows. So this means that a lot of landlords are freaking out right now. And so you've got a good opportunity to go to a landlord if you're renting a property and say, hey, I want to buy this and probably get a pretty good deal. And if you could buy it for considerably less than it's worth, then there's a possibility you can get in with little to no money out of pocket and do an SBA 504 loan. So as I mentioned, if you're doing commercial real estate, hard money, 65% loan to value. Remember, loan to value on commercial real estate can get as high as about 80%. Okay, depends on the purpose of the loan. The purpose of the loan means buy, build, refinance, cash out, refinance, etc. Okay, and you and your clients can also get SBA loans, which we talked about, with even higher or lower loan to values depending on the risk. Okay, conventional property financing, that's conventional banks, SBA loans. Money for investment properties, whether you're just buying them, not even to stay in it yourself, just for investment property. Hard money loans, bridge loans. Bridge loans are what we talked about earlier. They're where they're going to give you a 30-year amortization, 30 years to pay, but then they really want the loans over 8 years. Well, that's kind of a bridge loan because in a lot of cases, a bridge loan bridges the gap between what you can get now and the longer financing you want. So that way, for example, Kyle had asked earlier, he said, hey, man, what about credit issues? If I got a client or somebody with credit issues, can they get in? They can, but the terms aren't going to be favorable because it's soft money or hard money. So they might want to do that, or they might want to get a bridge loan to bridge the gap till they fix their issues and are able to come in and get a longer term loan, for example. So a lot of different types of funding: offices, industrial building, industrial facilities, light manufacturer building, self-storage facilities, mixed-use properties, commercial condos, auto dealerships, light oil services, daycares. I mean, I can keep literally, this could be 100 slides, because I mean, there's hundreds of different kinds of commercial properties. You can get financing for assisted living facilities, entertainment venues, multifamily properties, retail warehouses, and much more. And again, this is very valuable, because if your business owns commercial real estate, it's going to be worth more money when you go to sell it, or when you go to actually get financing for your business. Your business is worth more, because this is a big asset, probably one of the most valuable assets that a lot of businesses own. So as I mentioned, loan amounts of $20 million. You can get approved with bad credit. How bad is bad? We see people get these loans of 550, 580 credit scores. And again, you're using the real estate as collateral. They might want financials, tax returns, bank statements, depending on if the property can or can't pay its own debt. So commercial real estate financing used for a lot of purposes: buying, refinancing, cash out refinancing. Long-term tend to be shorter than with residential loans, but there are some added fees too. And a lot of the fees are similar, are survey fees, appraisal fees, very similar to what you'd find with residential real estate. And you can get it from SBA, HUD, conventional lenders. You can get soft money loans from online fintech lenders. You can get hard money loan from private investors. So a lot of option there as well, typically to get financing up to about $20 million. If we can help you along the way, give us a ring, 877-600-2487. We never charge you fees to get money at all. The way that we work is we have over 1,000 funding sources. You tell us what you want, we'll get you with the right funding source. Sometimes they give us a referral fee, sometimes they don't, but we do a lot of volume, 100 million plus when it comes to funding every year. So what we do is then we use our volume to get you lower prices, and then you pay less than what you typically pay with another source. But look, whether you use us or not, this is an important lesson I've learned when it comes to getting money, because I've been in this space for 20 years in the residential or the commercial and consumer side. Use a broker. Use somebody in between, because the somebody in between is somebody you could tell all of your sins to, and then they can help structure the deal the right way to get it done with the lender. If you go to the lender and tell the lender a bunch of stuff that you don't want them to know, well, then that's not going to work out favorably with getting the loan. But the nice thing about having a broker or credit suite or somebody in between is you can tell them everything. You can tell us everything. And then from that, we can decide the best source to go, and then how to package it where you have the best chance of getting it done. I don't care what you do. I just think even a residential mortgage, I think you should use a mortgage broker, because mortgage brokers can do more than banks, and they can typically get you better pricing. It's just the way that it is. And Ladybug says, yes, I bought an empty commercial building. The SBA loan I received was to get the building renovated and the lease up. Perfect. So you're already covered. I love it. So I was going to say, if you didn't get that kind of loan, that's the loan you should have got. So I'm glad to hear that. And Tyrone, hello from YouTube. Thank you for tuning in. If you got value from this, do me a favor, hit the like button. Okay. If you're on the channel, you can subscribe. Please subscribe. I appreciate that. That tells me we're on the right track. We do a lot to put the research together in this. And all I ask you for ever is one thing. Like it if you like the video. It tells the social algorithms that other people should see this as well. If you're on a channel like YouTube, you can subscribe. Hit the subscribe button. Hit the bell beside subscribe. Click all. And then that means you'll be notified when all of our content, when we actually go live. Speaking of going live, we go live on Tuesday and Thursday at 1, 11 o'clock on Wednesday, all Eastern time, on Facebook, Periscope, YouTube, and in LinkedIn now. And if you want to access our previous trainings, you can look on those channels. We have daily tips on Instagram, on Twitter. We also have it on our other social channels as well. You can access it all at the top right of our page, creditsuite.com. Even access our podcast where you can listen on the go. If you'd like to know more about the funding you can get right now, all the loans, all the credit lines, commercial real estate financing, everything you can get, including business credit, give us a call, 877-600-2487. On a consultation with us, we will tell you all the funding you can get now. We'll do a fundability assessment for you, getting information from secret reporting agencies that lenders use to make decisions about you that you can't even typically access on your own. And we'll tell you how fundable your business is. And then we'll even get you your business credit reports with Dun & Bradstreet, Equifax, and Experian for free at no cost. Costs you $249 from the Bureau. It all happens on one call. Okay, 877-600-2487. So let us know. Tyrone says, does Credit Suite act as a broker? Yeah, we really do, because we're not a direct lender, which means we don't lend our own money at Credit Suite. But so many people come to us for funding because we do so much for business credit that what we do is work with over 1,000 funding sources. And then what we do is you come in and say, I want to buy a commercial building. Here's all my scenario. We get the information that's needed and we say, look, you should go SBA. Here's a guy that's exactly the guy that will help you do it based on your industry, your risk. when I started Credit Suite, I started it because there's no one place you can go to access all forms of money in the business world. And that doesn't make sense to me. So we created Credit Suite to be a one-stop shop that whenever you want money for a business, you can come to us and we can help you find the right source to get you the best rates, the lowest interest rates, and the longest terms. So that's what we do at Credit Suite. We take you, we look at your scenario, we help you get all the money you can get through business credit, and then we get you with the right funding sources that could help you there as well. So that's exactly how we operate. All right, I'm going to wrap this up. Thanks everybody for tuning in. Please like and subscribe, and I look forward to seeing you in our next training that teach you more about getting money to start and grow your business. Thanks everybody. Have a great day.